Whether you're a seasoned trader or just starting out, understanding theta can significantly impact your trading strategies and outcomes. As a result, it is critical to have a solid understanding of theta when trading options. Theta, also commonly referred to as time decay, is one of the Greek letters used in options trading to measure the daily impact on the extrinsic value of an option. Theta does not only represent the time decay component of an options premium, but encompasses all extrinsic value components, including implied volatility, dividends, and interest rates. In simple terms, theta represents how much an option's value is expected to decrease each day, assuming all other factors remain constant. On the options chain, you will notice theta values associated with each option. These values indicate the amount by which the option's price is expected to decrease for every day that passes. Theta can take on different values and is measured in dollars. These values can change throughout the trading day and represent the expected reduction in option premium by the following trading day. Notice how, for each expiration, theta peaks at the at-the-money strike price. Also, the closer an option is to expiration, the higher the theta value becomes as time passes. Options lose value due to time decay, but this does not occur in a linear fashion. If you look at the graph, you will notice that time decay accelerates as the option approaches its expiration date. This happens because the option begins to rapidly lose its extrinsic value component. The higher the theta value, the faster the option's value will deplete. Imagine you hold an option contract and the price of the underlying asset remains stagnant or does not move significantly in your favor. In this scenario, theta decay accelerates day by day, and your option steadily loses value. This is crucial to understand, as it can directly impact your overall profitability. It is also important to remember that theta only erodes the extrinsic value of an option, not its intrinsic value. Intrinsic value is dictated by how far the option is in the money. As a reminder, extrinsic value represents any excess premium above the executable, or in the money, value reflected in the option's price. Theta behaves differently depending on whether an option is at the money or out of the money. Since the extrinsic value of an option will generally be zero at expiration, out-of-the-money options tend to have less extrinsic value because there is a lower probability of expiring in the money. At-the-money options, however, typically have significantly more extrinsic value. Theta values are centered around at-the-money options, which means more extrinsic value is priced into their premiums. As options move closer to expiration, they lose this extrinsic value. This results in a greater amount of extrinsic value to deplete as expiration approaches. The relationship between out-of-the-money and at-the-money option theta can be visualized clearly. Out-of-the-money options tend not to experience the same acceleration of theta closer to expiration because there is relatively little extrinsic value remaining to decay. At-the-money options, on the other hand, experience a significant acceleration in theta as expiration approaches. Theta has a negative impact on long calls and puts, as these strategies rely on an increase in option value to generate profits. However, theta has a positive impact on short calls and puts since these strategies benefit when option value erodes over time. This is why long calls and puts have negative theta, while short calls and puts have positive theta. Because theta works in favor of option sellers, it allows investors to potentially profit in neutral market conditions by using strategies with a net positive theta. A multi-leg strategy, such as a credit spread, is a good example of this. In a credit spread, the short strike is typically closer to at the money than the long strike. As a result, the short strike carries a higher positive theta, while the long strike carries a lower negative theta. This creates a net positive theta for the strategy, indicating that time decay is working in its favor. Assuming all other factors remain equal, the position will gradually erode in value by the amount of the net theta. In conclusion, mastering theta is a key aspect of options trading. Understanding how time decay works and incorporating strategies to manage it effectively can enhance overall trading performance. Successful options trading is not just about predicting market direction, but also about managing the factors that influence option prices. Visit bmo.com/online investing to get started.